As a new day trader, investor, or just someone who is interested in options, you may be wondering, well, what are options? I heard that it's a way to make a lot of money fast, or it's a lot of ways to really increase your net worth, and I want to learn how to do it without screwing things up. Well, you have come to the right place, because today we are going to talk about what options are, how they work, how to place your first options trade in just 4 steps, and just break everything down so that way you could be able to do it successfully. And if you don't know who I am, my name is Lakeisha Tomlin. I'm a former engineering manager turned full-time day trader, and I help new day traders become profitable in 60 days, sometimes less. So today we are going to go over a whole lot of things, options, in order for you to be confident and comfortable with placing your first options trade. So you may be wondering, what is an options contract in the first place? And an options contract is basically, if you understand what one share is. One share is basically you're buying a tiny, tiny piece of a company, and each share represents ownership. So a contract contains 100 shares in the United States. It may be another number outside of the United States, but it contains 100 shares in this contract, and it gives you the right to hold these shares and make money off of these shares, although you don't own them. So you may be wondering, well, how does this even work? Well, a good example would be like when you go and get a car. You have the option to lease or purchase. So say you don't want to purchase the car, but you want to lease it. It's essentially renting the car. You get to enjoy the benefits of having that car without owning it. And options work in the exact same way, where basically you don't own the shares, but you get the benefits from holding the shares for a specified period of time. And we'll talk more about what this time period is in the future, but generally you're essentially renting the shares. So you may be wondering why options contracts are even beneficial in the first place. And the thing I really like about options is that you don't have to own the shares in order to benefit. So say, for example, you were interested in a company that is trading at $100 a share. If you multiply 100 times 100, then that's $10,000 in order to be able to acquire or own those shares. If you don't have $10,000, then an option may be a good resource for you, and it definitely has been for me. So I really like tech companies, and I'm looking at other industries now, but basically I don't want to own 100 shares plus of all of these different companies. So I like to use options, and I hold them for a period of time, maybe a few hours, maybe a few days or a few weeks. And if the price of the contract is going up, then I make money. Of course, if the price of the contract goes down, you lose money. So the benefit of that is with the options contract, you only lose how much you put in. So say, for instance, if you bought contracts worth $500 and you hold the contract until the value is 0, all you lose is $500. Whereas if you had the shares, those same shares, and you held it, it could actually be more negative than what you purchased them for. So that is one of the benefits of holding an options contract. So some of the options benefits are things that you need to think about. So some of the key decisions when it comes to doing options, one is the financial piece. It's not having, say, $10,000 for shares that are trading at $100, and you want to be able to benefit. So that's one consideration. Another thing to understand, the differences between calls and puts. So calls and puts are basically options terminology. If you hope that the price is going up, then you're going to buy a call. If you hope that the price will go down, then you will buy a put. So basically that is simple terminology, because you will see this when you are on your broker like Thinkorswim or Robinhood or Webull or whatever you use. You will see this terminology, and that is essentially what that means in a nutshell. And since you don't own the shares, you will be buying either a call or a put. Now there's a more advanced topic on selling calls and puts, but we won't go over that in this video because it is way too advanced. So right now we'll focus on buying calls. That means hoping that the price goes up, or selling puts, hoping that the price goes down. So if in the short term, or maybe within the next few months, if you see a company that you're interested in and you are very bullish on it, meaning that you're believing that the price is going up, then a call would be good for you. If the opposite is true, if you see a company, you think that the price is coming down, then a put may work for you. So that brings me to the next consideration, the time in which you hold the contract. So basically there are weeklies, there are monthlies, there are things called leaps. And basically when you buy a weekly, this is the expiration date of that contract. If you remember before where I said you're holding the contract for a specified period of time, this is where you'll see this expiration date. And then there's these monthlies where you may hold them for 28 days or maybe a few months, depending on the expiration date. And then there's something else called a leap, where basically you may hold them for 6 months or maybe even a year. And every contract has a premium or a price. And when you see these prices, it may look incredibly cheap. So for instance, say if you're interested in buying a call because you're hoping that the price goes up or you have a bullish outlook, and then you may see that one contract is $2.50. Well, it's not necessarily $2.50. It is multiplied by 100 because remember, each contract contains 100 shares. So it would really be $250 to own this contract. So the premium plays a part in how long you hold it. So for me, I mostly go with weeklies, sometimes monthlies, just because the cost and compared to a longer time period, say 6 months or a year, is much, much cheaper than getting this stock or getting this contract for that longer period of time. Another thing to consider is something called implied volatility. Now, IV is basically how volatile the stock is. Now, volatility is not necessarily a bad thing because a stock with a high implied volatility may be more beneficial for you in terms of going ahead and making more money in the short term. It all just depends on your strategy and what you feel comfortable with. Another important thing to have when you're considering purchasing an options contract is your exit strategy. So a lot of times before I even buy an options contract, I determine whether or not I believe that the price is going up or the price is going down, and then I determine at which period I get out of the market. So basically when it comes to me exiting that position, say if I purchase a call and hoping that the price goes up, but instead it goes down, that means that my contract is losing value. And remember how I said that with the options contract, you can only lose what you put in? So say for instance, if I bought $500 worth of contracts and the price, instead of going up, it's going down, and I only want to lose about $100, which is about 20%, then what I could do is close out my contract when it hits $100, negative $100, in order to not lose the remaining $400 of my money. And I do this almost daily when I see a good opportunity because I don't want to lose all of the premium or all the money that I put inside of the options contract. I only want to cap my losses because once the price is at a certain point, and there's basically a point of no return. So that is more of an advanced topic that we will cover really briefly. So you may be wondering at this point, I learned about the premium or the cost of the contracts. I learned about expiration dates. Then what happens when the contract ends and it expires? Well, that is a good question because it brings me to my next point. where basically at expiration, since you don't own the shares, one of two things could happen. So the first is, well, actually one of a few things. So the first is you can end in profit. So basically you have successfully made money on these contracts, which is amazing. That's the thing you want. So you could close this out before it expires in order to be able to keep the money that you gained during the time period you were holding these contracts. The second thing that could happen is your contract could expire worthless. And this is essentially true if there is no more value inside of the contract. So remember how earlier I said that you can close the position earlier in order to not lose more money if it's currently at a loss? Or you could close it early if you're in profit, whatever you want to do. But basically the only way that a contract will close with no value left is if you let the contract go in the negative for the entire amount of money that you put in. So if you put in $500 and it went to negative $500, then that contract will expire worthless because there is no more value inside of that contract. And the third thing that can happen is you can exercise your right to buy the shares if you want to. So going back to the car example, if you leased a car because you didn't want to own it at first, but you've been driving the car for a few years, you love the car and you want to keep it, then you could say, hey dealership, I actually want to keep this car. How much money would it cost in order for me to be able to keep this car? And with options contracts, it works the exact same way. So before the contract expires, you can exercise your right and you could keep the shares, but of course you have to pay whatever that amount is for those shares. So say for instance, if it costs $10,000 to get those 100 shares, then you have to pay the money in order to be able to keep the shares. Just like with leasing a car. And the cool thing about contracts is that you can repeat this process over and over again. It's just an incredible thing when it comes to options. You could benefit without even owning these shares, and you could do it as many times as you want. Now, if you made it this far inside of the video, go ahead and write an "I'm with you" in the comment section below. And if you haven't already, go ahead and like this video. And then if you haven't already, go ahead and subscribe to this channel so that way you can see more content like this. Now, the next part we're going to do, I'm actually going to run you through an example so that way you could buy an options contract in just 4 steps. And it's going to go really quick because we've talked about a lot of the key things already, but just for clarity, I am going to cover some of those things again, just so it could really seep into your brain. So that way, when you're doing this on your own, you'll know exactly what you're doing and what everything means. All right, I'm in Robinhood right now and I just started recording my screen so that way whatever I'm looking at, you can look at and follow along. So as you can see, I got about 500 or so bucks inside of this account. Now I don't use it all that often, but it is one of the simplest platforms to use when it comes to trading options. And I actually just put more money in here because it is so easy to open and close trades in here. So as you can see, I got a little bit of something happening down there, but let's go ahead and search for a company. We're going to search for one of my favorite companies in the world, Apple, and just see how their stocks are doing today. So as you can see for today, it's only up about 2 or 3 cents. It changes because the market is still open right now. But if we want to go ahead and trade, all we got to do is hit this trade button and then trade options. Now, if you don't have options enabled on Robinhood, then go ahead and check out this video because I give you a full tutorial step by step, no matter if you're using your phone or if you're using a desktop computer. I show you both ways on how to enable this so that way you can start trading options. All right, so now you can see where it says, I think it's going up or I think it's going down. Let's just say we think it's going up. So we want to choose an expiration date. So since today at filming, Today is August 31st and September 2nd is just a couple of days away. I don't think I want to go ahead and choose that just because it's such a short amount of time. So let's go ahead and select September 9th. So now it comes to this screen. So you see buy and sell. I'm toggling it back and forth. We want to be buying because unless you own 100 shares, then it's not going to make sense really for you to sell shares. Though that is a whole other topic and we won't talk about it today because we're only focused on buying. So we're going to buy, and if I think it's going up, we're going to select call. So as you can see, call is selected, and you can see all of these different numbers right here. I just clicked on one, but you can see that the share price is currently $158.88. So if we think that it is going to go up between now and September 9th, then we want to choose an option that is either out of the money, and that means that the price is that the strike price here. So these numbers that you're seeing where it's like 157.5 call, 155 call, and 152.5 call, you're gonna choose something below there because those are known as out of the money calls. And basically, if you look at the prices, so there are different type of strike prices that you can choose. So there's out of the money, in the money, and at the money. So typically when I'm choosing a strike price, I like for there to be an at the money or in the money strike price. And what I mean by that is basically you see where the share price is currently at 158.97, and it changes second by second, mainly because the market is still open. But an at the money call would be one of these strike prices that are basically hugging the strike price or the share price. So that's going to be the 157.50 call or the $160 call. So those are known as at the money calls. And if you look at the prices between these different contracts, which you see over here, it changes second by second. The market's still open, but you can see for the $160 call that it is currently trading at $2.60 roughly. And the one below it, the $157 call and 50 cents or 157.50 call, is now trading at around $4 per contract. But remember, this isn't really $4 and 263. It's really that number multiplied by 100 because you have 100 shares inside of your contract. So that's really $262 and $405. And the difference between the price is basically how much value those contracts have at this moment in time. So the $157.50 call has more value than the $160 call. Why is that? Because we're looking at it from the standpoint of the prices going up. So if we're, say for instance, if the share price right now, it just moved to $159, but we bought a call at $157.50, that means that the share price has grown from $157 to $159. So any prices below this share price will have more value. And as we scroll down, we can see that the prices are getting more and more expensive as you go down. That's because they have something called intrinsic value. So that means basically how much value is inside of the contract at this moment. So if we scroll back up, then we can see that these strike prices of $162.50, $165, and so forth, they have less value, mainly because they don't have any intrinsic value because the share price has not reached that point in time yet. So say for instance, if we want to get an at the money call or actually let's do it in the money call, because typically when I'm purchasing contracts, I want something that's already in the money, means that it already has some value. And if the price continues to go up in this situation, then we're going to increase the amount of value that we have inside of our contracts. So let's go ahead and select this 155 call. So now you see that the screen changes. You see that there's something called bid and ask, and there are people fighting it out right now, trying to bid on these contracts, and there are people who are selling the red side that are asking for a certain amount for these contracts. So it keeps going back and forth. But some of the key things that you need to pay attention to here is the mark price, and that's basically the price at the moment. So it just jumped up to 575, and the last trade price, so how much somebody just purchased this contract for, and then implied volatility. That is the thing we talked about before, IV, which is basically at 33%. So relatively, this is low volatility, and Apple is one of those companies that typically have a low volatility, which means that the price doesn't fluctuate a lot. Like some other companies, maybe some of the other tech companies where their implied volatility may be over 50%, 70%, or even over 100%, which is insane. But typically anything under under at 50% IV is really going to help you out, because there won't be these crazy price swings, especially if that's not something that you're looking for. All right, and the next thing we're going to look at is the chance of profit. So if you go down, you'll see that there's a 41 roughly % chance of profit, and this is mainly because of the probability that your price of 155, your strike price, will be maintained or even higher before September 9th. So this is something that I look at, and this is closer to an at the money call, although it's in the money. So basically, the more out of the money you go, like the strike prices we saw before with tiny premiums, they're cheap because their chance of profit is very low. So just let me show you that really quick. So we were at the 155. We'll come back to that. Let's go to a 170 call. So the probability of Apple's price being at $170 by September 9th, there's only a 6.18% chance of profit in this case, which is why the price is only $21 for this contract. And basically you'll just be throwing your money away if you do that, because it is very low probability that it will be profitable by the time you get closer to September 9th. So let's go back to our in the money call. All right. So another interesting thing I like to look at is volume. That's how many times this contract has been exchanged between two different parties, and open interest. So that lets you know how many people are interested in this particular stock. And basically, the higher the open interest is, the easier it is for you to buy and sell really quickly. So typically I like to look for an open interest of at least 500 or more. 1,000 would be amazing, like this one, because if I need to get out of it really quickly for whatever reason, then I have 1,100 people, in this case almost 1,200 people, to sell this to. So another important thing is the Greeks. So when it comes to choosing a strike price, I said that I like to choose ones that are in the money or are at the money, and the delta, the first number, is one of those numbers that I really look at when I choose a strike price. So I really like a delta that's at 0.70, like this one is right now, or it keeps fluctuating because the market is still open, but basically this would be one that I would definitely like to buy. Mainly because delta means that for every increase in the share price, your contract price is going to increase by $1. So say for instance that this stock goes up $5 from where it's at right now, and that means that for every dollar that it goes up, $5, that my contract value will increase by $5 as well. So what that could possibly mean, and it's not 100% because these numbers are always moving, but it could possibly mean that this contract goes from being worth $565 or $5.65 to $10.65, or if we multiply by 100, $1,000 in 1,065. So basically it could essentially double, this contract if the stock price was to go up by $5. And it's amazing how these little tiny moves of just $5 could greatly increase the value of the contract. Another thing that I look at is theta, and that is something called time decay. So basically for every day that I hold this contract, the value of the contract will decrease by 16 cents, almost 17 cents, or remember, we're multiplying everything by 100, so it would decrease the value of the contract by about $17 each day that I hold it. And another thing to note is that the more closer you are to the current stock price, so at the money, those have a higher time value decay. So let's just look at an example. So we're at 155 right now. Let's go to the 157.50, and then you can see that the theta here is 17.7. Oh, it just jumped up 90. So it's slightly higher than the other one, which means that this contract is going to lose more value, or lose value more quickly than the 155. So let's go back to 155. And the other ones, I don't really look at those. I mainly look at delta and theta when it comes to it. So now we understand the numbers. I like what I'm seeing. So let's go ahead and hit buy. So now it's going to go to this screen, and let's just say I only want to buy one contract. You can buy however many contracts as you want. Just know that the more contracts you purchase, the more that the stock it'll be very sensitive to stock fluctuations. So if this is your first time, I would only suggest that you purchase one contract just to get the feeling. And I don't go crazy with contracts these days, even though I do understand it. So I think the most I purchased at one time was probably like 30 contracts, but it was something that was really cheap. So it was all good. And I'm purchasing one here. So you see this bid and ask, and current price is at 550, and you see this check mark here, high fill likelihood, which means that the price that I'm asking for, let's just type in 580, or the price that I want to pay, $580, it changes with the demand. So you can see that it's flipping back and forth between medium and high. So let's just say we wanted that. And then the other thing I like about Robinhood is if you press this little arrow button, you can see what your max profit is and what your max loss is. So remember, when it comes to options contracts, you can lose just the amount of money that you put into it. So I'm putting in $580. And then I won't lose any more than $580. Now we saw I only have 500 bucks in here, so if I tried to buy it, it's not going to go through. But let's go ahead. See, not enough buying power. Deposit funds, so we're gonna dismiss because I wasn't planning to purchase this anyway, just to run through this example. But basically, this is how you analyze and buy your first options contract. Once you hit buy, if I had enough money, then I would be the proud owner of one contract of Apple. And then I could wait to see if this would go up by September 9th or go down. So we don't know. So basically, this was a run through of how to buy an options contract. And if you love this content, go ahead and hit the like button for the YouTube algorithm so more people can see this content. And if you haven't already, go ahead and subscribe, and then check out some of these videos here on the side so that way you can learn more about day trading, more about investing options, whatever you want to learn. I'll see you next time.